Hello, I'm Ed Parrott. Welcome to my weekly real estate market roundup. Let's start this week with a look at a letter written to Fed Chairman Powell, and this was authored by the National Association of Realtors, the National Home Builders Association, and the Mortgage Bankers Association. They expressed concerns about the high mortgage rates being caused by the uncertainty in the path the Fed is taking on their federal funds target rate. They state that this uncertainty has exacerbated the affordability of housing, and it's done so in two different areas. Number one, the mortgage rates themselves are very high right now. And number two, because of the high mortgage rates and the fact that several years ago the rates were anywhere from 3.1 to 4.5%, current homeowners that have a mortgage in that area are very reluctant to sell because when they buy something else, they're going to be paying currently about 7.5%. And we'll get to the actual rates later on in the discussion. But this has resulted in a very low supply of housing, and that has resulted in very high prices for housing. They point out that this is causing a severe strain on the housing market, which is struggling to recover from a dramatic drop in mortgage applications and home sales. According to the MBA's latest report, mortgage rates are at a 23-year high, and the number of mortgage applications have fallen to a level not seen since 1996. They point out that the spread between the 30-year average mortgage rates and the Treasury bond yield is at historic highs, and this signals a profound uncertainty in the market about the direction the Fed is heading. They further point out that the difference between the current spread and the long-term average indicates that mortgage rates are at least 120 basis points above where they otherwise would be. So for a $300,000 mortgage, this means that the consumer is paying an additional $245 per month on their mortgage payment. They further point out that a leading cause of inflation is in fact shelter cost, and I do intend to discuss that in a little more detail later on in this report. So we'll just have to wait and see what the Fed actually does. The next meeting is October the 31st and November 1st, and of course the report will come out on the 1st. At the last meeting, the consensus was that this meeting would result in another 25 basis point increase after they paused their rate increases last meeting. I'm seeing a number of industry analysts that are now thinking that the Fed might actually pause one more time, and that would certainly be a good thing. In my opinion, I would actually like to see them reduce the Fed funds target rate 25 basis points. Currently it's at 5.25 to 5.5, and if they do bump it up, obviously it'll go to 5.5 to 5.75. I think if they would go ahead and drop it to 5.0 to 5.25, that would be a major boost to the real estate market. It would take pressure off of the mortgage rates and might actually open up some buyers to be willing to sell if they thought interest rates were on the way down slowly, but hopefully surely. Unfortunately, the number of hawks on the Fed outnumber the doves considerably. Of course, Chairman Powell has been on record as favoring higher, longer, and of course he's also quoted as saying he thinks that the housing market needs a reset. So, how big a reset he wants, I don't know, but he's certainly driving in that direction. I hope we don't see another '08 situation. But in addition to Powell, there's Kashkari out of Minneapolis, the Fed president out of Minneapolis, and I quoted him last week's report, so you can go back and look at that if you'd like. And of course, there's Logan out of Dallas and Meister out of Cleveland. I quoted her a couple of weeks ago. So, and board members, now those three I've just mentioned are Fed presidents at the local branches. and if you want to call Minneapolis, Cleveland, and Dallas local branches. But they're also board members, and of course board members vote every year, and the presidents vote on a rotating basis, and actually Meister is not a voting member this year, so although she's hawkish, yeah, she's not voting, but I'm sure she has influence in any case. On the other end of the spectrum, we have Goolsby out of Chicago and Bostic out of Atlanta, who are both dovish on the rate increases. So hopefully sanity will return and we can get the rates back under control and back down to a more normal level. I would like to take a minute to talk about the difference between the Fed funds target rate and the Fed funds effective rate. The target rate is what the Fed Board of Governors sets as what they, quote, target for the overnight lending rate between banks, and that is, in fact, the Fed funds effective rate. Now, in this chart here, we can take a look at the federal funds effective rate from 1990 on through the current date. And the interesting thing we want to take a look at are these shaded areas here. Those are recessions. So as you see, there's been 4 of them in that time period, and many people are afraid that we're about to have another one because of this right here. So anyway, looking back at 1990, the effective rate was 8.45%. And yep, that was enough to bring us into a recession right there, and the rates started dropping rapidly and leveled off around 3% and then started back up in the mid 90s and just hung around there about 5.5%. And got up to just shy of 7% there. And again, you notice the slope up here, and after the slope, what did we get? Another little recession. Well, I wouldn't say that's a little recession. That was, let's see, from March of 01 through November of 01. So basically 7 months worth of recession there. And when we came out of the recession, they kept the rates low for a while. And then here they go, ramping back up in 05. And now, I don't attribute the entire problem in 08 to the increase in rates here, however. The problem in 08 was during the period running up to that, the government was encouraging mortgage lenders to make loans available. And there were all kinds of programs going, most notably the so-called no-doc or no documentation loans, where a person just said how much they made and that's what they made. And as a result, there were a lot of loans granted that should not have been granted. And when we started seeing a little bit of a recession there, then people started defaulting on their mortgages, and that caused the significant drawdown in housing values at that point. However, as I said previously, if one were wise and able to ride out the storm, keep making your mortgage payments and stay in your home, and eventually it will come back up. And I gave the personal example of my friend down in Florida. If you want to go back and look at my previous report, I think that was like 3 weeks ago. But in any case, that, in my opinion, was the major cause of the 08 housing bubble. And there's been a number of people talking about housing bubbles now, but I don't believe we're in the same situation at all, because the standards for getting a mortgage are definitely much tighter these days. And as far as I know, there's no such thing as a no-doc anymore. I'll have to ask Janine Stone, the lady that I work with at Bay Equity. She's the head of the office there here in Knoxville, and verify that no-doc is not a thing anymore, but I don't think it is. But in any case, you see here from 2010 through 2016, rates were effectively zero for the overnight interbank loans. And then in 2016, they started coming back up. And again, a little peak there, and there was a little recession there. I don't really think that recession was a result of this little boost in rates either. However, we did they really started raising the rates, I think, in April, the Fed target rate in April. But as you can see, it started bumping up a little bit even before then. But the effective rate climbed rapidly through 2022 and on into 2023 here. And currently, the federal effective rate is 5.33%. And as I mentioned, the target is currently set between 5.25 and 5.5. In the actual housing market, the persistently high rates and the high prices have finally started to wear on the buyer demand. Buyer demand has remained surprisingly strong over this period, but the September survey of buyer sentiment conducted by Fannie Mae showed that the percentage of respondents indicating that it was a good time to buy has fallen to 16%. That's the lowest level in 2023, and it ties the lowest level in 2022. At the same time, the survey showed that the percentage of respondents that thought it was a good time to sell has increased to 63%. And I would tend to agree with that. It is probably a good time to sell if you are inclined to sell. I grant that rates are very high right now, and whatever you buy to replace what you sell, you will be paying a higher mortgage rate, and may be doing so for 2, 3, or 4 years. I think 4 years is probably on the outside. 2 to 3 years I could see before rates come down enough to justify refinancing to get back to a lower rate. But the reason I think it's probably a good time to sell is I think we're about to plateau, if we have not already plateaued, on the home prices. And we'll talk more about that in a little bit after we cover inflation. So moving on to inflation, let's take a look at the Producer Price Index first. The headline Producer Price Index increased 0.5% month over month for September, and that resulted in a 2.2% year over year increase for the headline PPI. Now, the 0.5% was a little bit more than expected, but the PPI is not out of control at this point. And moving on to the core PPI, which excludes the volatile sectors of energy and food, the month-over-month increase was 0.3%, which was just a little bit higher than the 0.2% that was expected, but that resulted in a year-over-year core PPI increase of 2.8%. So it's not too bad at this point on the PPI. Moving on to the Consumer Price Index, that came in with a headline number of 0.4% month over month for September, resulting in a yearly increase holding steady at 3.7%, the same as it was in August. But again, let's consider that the headline CPI includes the volatile sectors of energy and food. So when we look at the core CPI, that came in at 4.1% year over year. And while that's down from the 4.3% from August, it's still above the Fed's target of 2.0%. And that makes me worry that the hawks are going to express themselves vociferously. And I would love to see them do another pause, but I don't have my hopes up too high, honestly. One thing I don't understand, the entire goal of the Fed is to get inflation down to 2.0% for the core CPI. The core CPI, a major component of it is in fact housing cost or shelter cost, as it's referred to in the report. And the fact that they have kept their Fed target rate so high and raised it so rapidly, driving up mortgage rates, which has in turn reduced supply, which has in turn increased the cost of a house, they're working against themselves, So if they would just relax their aggressive stance for a little bit and let the rates come down a little bit, that would ease off in the housing market and would also provide some relief on the core CPI. We spent a considerable amount of time talking about the Fed funds target rate and its effect on inflation and also on mortgage rates. So let's take a minute here to look at the actual mortgage rates for this past week. Now, as we have previously said, we've had a 23-year high in the mortgage rates. In fact, we've hit a couple of new 23-year highs in the last 3 weeks or so. We had our most recent peak on October the 6th at 7.81% for the 30-year average mortgage rate. Currently, we're standing at 7.52%, and the low happened back in February. That was 5.99%. 1 year ago, we were at 7.14%, so we're about 0.4% higher than we were this time last year. I'm going to take a look at the Zillow price index this week since Case-Shiller has not published their latest report yet. The Zillow report shows that we had a 0.1% decrease in home prices across the nation for September. And that's the first decrease since January and February. In January, we had about a 0.9% decrease, and in February, it was around a 0.4% decrease in home prices. So it kind of looks to me like, as I said, I think we're plateauing on home prices and may see a little pullback here. But this is because I think the high interest rates and the high prices have finally cooled off buyer demand enough that we're going to see some price pullbacks. And that's also reflected in the days on market. Here locally in Knoxville, the days on market have ticked up to 33. Nationwide, days on market are now standing at 36. So as that increases and the inventory of homes increases, we're going to see prices under a little bit of pressure. I hope we don't have a crash, but I would not be surprised to see a reasonable sized little pullback. Thus, my opinion, now's the time to sell if you're going to sell. So as we can see on this chart, the home value index from Zillow varies widely based on where you're at in the country. For the U.S. as a whole, we'll notice at the bottom of the chart there that we had a 2.1% increase in home values year over year, as opposed to the 0.1% decrease for month over month from August to September of this year. And it's interesting to note that there is a wide variation here. Hartford, Connecticut had an increase of 11.1% in home prices year over year. And the various other cities you can see there, the value or the rate of increase goes down. And one interesting note I see there is San Diego. They had a 5.1% increase. And the reason that is interesting is generally the West has been hard hit on pricing. So I'm not really sure what's going on in San Diego that they had the increase, but that did stand out to me. And then as we go on down, we start turning negative at Seattle. They had a 0.3% decrease in home prices. And not everything was in the West. Tampa was down 0.5, Memphis down 0.6, Nashville down 1.7. Now personally, I've thought for quite some time that Nashville prices were a little overinflated. But Nashville is a popular place to be, and it is all about supply and demand. So there you go. Also of note, Jacksonville down 1.9%. And really of note is Austin and San Jose are both down 10%. Now also of note is Phoenix and Las Vegas are both down about 4.2, 4.3%. But the reason that's of note is they were down even more, so they both recovered a little bit in the last couple of months. So that's it for this week. Thanks for stopping in. If there's any topic you would like to see discussed, either as a separate subject or included in one of my weekly reports, put a comment below and let me know what you'd like to talk about. And otherwise, I hope you got some good information out of this report. And if you enjoyed it, please click the like and subscribe. And I'll see you next week.